Friday, May 17th, 2024, Monaco 64, home of alternative economics and contrarian views. Clive is back today. Clive, welcome to the channel again. How are you?
Hello, Mario. Good morning to you. A nice sunny day here in Switzerland.
Yeah, it's sunny here too. I had to put the curtains down so it's not too much light in the picture. Yeah, for a change in
Put
the
some light on me.
yeah.
Oh, yeah. Yeah, we've got a bit of light behind, but I think you can see me
No,
clearly.
you're okay. And you've got someone special behind you. Maybe you want to show the viewers. It's Tigger, and he's reading a book, is he?
He's reading a book about gold fields.
Oh,
I think one of the things we're going to talk about is the silver mines, not really gold mines, but I didn't have a book called Silver Mines,
yeah.
but I put that there just for the show.
Yeah. So for the viewers, what we're gonna touch upon today is silver, the silver miners. Jay Powell, he was in Amsterdam recently. I think he likes those bars in Amsterdam. You know, he goes there before he talks, and that's why he talks a lot of BS, I think. But and we're also gonna look at GameStop because it's come back in the news. And why is it significant for gold or silver? Well, it's all to do with naked short selling, and that's what GameStop is all about. But Clive, let's start. You want to start with Jay Powell?
So I watched the conference between Jay Powell, the um, editor, or rather one of the journalists from the Financial Times, and the chairman or the head of the Netherlands National Central Bank. It's called the Nederlandse Bank, and he's also of the governing council of the ECB. That's the body which sets the interest rates for the euro in Europe. But I think the most interesting part about it was what Jerome Powell had to say about the national debt and the budget deficits. And I'll come on to the interest rates in the USA in a second or two. He was asked by the journalist if it worries him, if he finds it is tricky for his policies when the government is thwarting what he's doing by increasing their deficits and increasing the level of debt. And he used two words in his reply, which I thought were quite significant. One is the word unsustainable, and the other one was very concerned. And I'll just read to you some of the actual quotes that he said. He said, I think it is utterly non-controversial to say that US fiscal policy is on an unsustainable path. Now, there we have the head of the central bank in America saying that they're on an unsustainable path, talking about the administration of the government and the overspending. And he went on to say, we're going to have to deal with this sooner or later, and sooner is a lot more attractive than later. Then he said, I think you mentioned the Congressional Budget Office. And you know, Mario, I often refer to people to the Congressional Budget Office here on this show because I'm talking about their forecasts of the way things are going based on the official budget of the United States. And he said, I think everyone and anyone should be reading the things they're publishing about the US budget deficit and the path. And they should be very concerned that elected people need to get their arms around it as sooner rather than later. So here we have the head of the world's largest central bank expressing the kind of concern that you and I have been expressing on this channel for years now, Mario, that basically things are out of control. The level of debt is spiraling to higher and higher levels, and that's due to a deficit. They're spending far more money than they're collecting in taxes, and there's currently no debate about how to either cut the spending nor any debate about raising taxes. So the situation is not immediately going to be rectified and might never be rectified. And based on the Congressional Budget Office's forecasts of the level of debt and the interest which will be paid on it, it won't be too many years before the interest being paid on the government's national debt exceeds the entirety of their tax collection. And of course, that is a precursor to potentially some kind of currency crisis, some kind of debt crisis. We don't know how it'll play out, but I can tell you it won't be very good for those who are holding cash in the bank, large balances. I'm not talking about the small guy. It won't be very good for those who are holding dollar bonds or treasury bonds. And I just think that either something has to be done about it, or what we're advising the people who are listening to this channel is to do what you can to protect yourself.
That's right. And there will be a lot of people who will counter you and say people have been warning about the debt and the deficits for decades, but nothing ever happens. But I would say that, and I'm going to use a sailing analogy. Um, I used to say when I was a kid in Brazil, and I know how tough it was to sail upwind, against the wind. It was very tough. You had to tack. But then when you went around the buoy and you went downwind, it was like plain sailing, as it's called. And I think you've had that since 1981 to 2021, where the bond cycle was one of lower interest rates, and you also had globalization, where you had countries like China, Russia, and others participating and buying your treasuries. But it seems to me that that was the down the wind. And now we're going against the wind, and it's a big storm. We might even capsize our boat because interest rates are rising. Like you said, the deficit is out of control. And I'm going to share here quickly. I'm not going to get too much into the China Russia situation, but I just saw a tweet by Willem Middelkop. He said, "Want to understand why China turned friend to foe? They started selling U.S. bonds. So China's selling of Treasury and U.S. debt agency debt rises to record. So that's the other thing, Clive. And the geopolitical is going to be a big impact. So
Well, I've got a book by William Middlecoop. I'm just having a look to see if I can lay my hands on it very quickly.
yeah,
Here we are. It's called The Big Reset.
yeah, he used that term even before Klaus Schwab, and I think it's happening right now. I don't have that book. I might get it. But I've listened to him for many years. So that's what I want to, people are going to counter, the milkshake, dollar milkshake people, that the dollar is going to always be important, that the deficit and the debt has been unsustainable for many, many decades, and nothing's going to change. But I agree with you, Clive, for the Fed chairman to say that is very serious. But I would also add that he's partly to blame, and other Fed chairmen and women, by helping the Treasury with all the QE they've done since 2008. But that's a different topic. So I said I wanted to look at GameStop, and you might think it's weird, but I remember when it happened in 2021 that I thought to myself, we need this kind of movement for silver and gold, because I've been telling my viewers even before GameStop that they needed to buy physical, because the bullion banks basically they sell naked short contracts on futures, even ETFs probably in the LBMA as well. They sell gold. They don't have an allocated, it's called. And I'm just gonna share here uh, a quick, where is it? A quick clip of this guy who used to work for Morgan Stanley. And because some people think that when you sell stocks short, that you have to borrow the stock. But here we go. I'm going to play not the whole thing, but you see what I mean. Morgan Stanley employee.
Folks that are still, in the industry, and they've been like, well, I wouldn't advise you to talk about it, blah, 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 blah. But I think that they're living, they're all living in kind of a fake world. I would, illegally naked short sell stocks every day, as long as I was collecting commissions. And the bank did not care. The client will send you an order electronically. All you do is you click on the order, you go to execute, it'll pull up a little box, you type in anything you want, and you just hit okay. You don't ask questions. You appreciate the order. And if that involves shorting a stock, make it. You do it anyway. Because management essentially tells you just create the business. Anything on the backside, we will deal with. So you're collecting money on the front, you collect money on the back, and you actually have zero risk. Clients never see that. All the prime lenders, they all do it consistently.
So there you go. And then they go on to talk about Goldman Sachs, how they did it as well. I'm going to play that clip. Here we go.
We have this whole team of people tucked away in a back office. When a client would call to borrow stock, the team would use computers to automatically locate stocks they had in inventory. This is normal. You always gotta locate a stock before you loan it, because you obviously can't loan something you don't have, right? Well, halfway through the day or so, the inventory could dry up. The system would say, no more shares available, sorry. Wah, wah. The Goldman was like, fuck that, must be secret stash somewhere, right? So they'd say, we have reasonable belief there are leftovers we can locate. And they created a program where when you press the F3 button on your keyboard, poof, it overrides the dried up supply. That's it. Just hit F3 and the computer would say automatically located, even if it wasn't true. So you could do this as many times as you want, magically creating phantom shares that didn't actually exist. But guess who works in the building right across the street? The SE motherfucking city. So Goldman got caught and paid a $15 million settlement, which in normal person dollars is like, I don't know, like 23 cents.
All right, we'll stop here, Clive. So you can see why that is important. And I think it's been happening to gold and especially silver. But we're here to talk about what Clive is seeing in the silver market and the silver miners.
So first of all, let's start with the latest from the Silver Institute, which have brought out their 2024 forecasts, Mario. And I'd like to just share the screen because it's very interesting for your viewers to see the numbers that they're forecasting for 2024. Let me just bring that up. Yeah. I think that's it. Share. Do you see the screen now?
Yeah.
So if we look here, this has got at the top line where it says supply mine production, it's got the mine production from 2015 going forwards right through to the forecast mine production for 2024. And you can see that the production of silver year by year has been falling. And this year, they're forecasting they're going to have 823.5 million ounces of silver produced from the mines, which is less than last year, less than the year before, and less than the year before that. And it's also less than the amount of silver they were producing 10 years ago in 2015, significantly less. And if we move down to the demand line, which is called the main one being industrial demand, we can see that year after year, the industrial demand has been rising. And this year, 2024, there's quite a reasonable increase. It's about 10% increase or 7 or 8% increase from the previous year, which was higher than the year before that, which was higher than the year before that, which was higher than the year before that, and so on all the way back to 2015. So in 2015, the annual industrial demand, and there were other forms of demand which are listed here, but the annual industrial demand was 457 million ounces, and in 2024, it's forecast to be 710 million ounces. There are other uses of silver other than the industrial demand, one of them being photography, another one being jewelry, another one being silverware, and so forth. And what's interesting is
Oh,
that
I guess the silver stackers, net physical investment.
and net physical investments, I beg your pardon, yes.
Yeah.
What I find the most interesting part is they are forecasting for 2024 to try and bring things into balance, that the silver stackers will be buying 28% less silver in 2024 than they bought in 2023. Now, given that silver is now clearly in a bull market, I find that puzzling, because you'd have thought silver stackers would be buying into the bull market rather than not buying, which is what they're forecasting. But that's how they make the numbers balance, by basically more recycling and silver stackers buying less of it in the current year. In other words, we're going to buy, according to them, less coins, less bars, and so forth. I frankly don't believe that. I think the silver stackers are going to buy more this year than they bought last year. I think it could well be a record level of buying. But bottom line here is that we are now in a situation where the consumption of silver for some years, but this year will be more than ever, is massively exceeding the newly mined production, with the difference being effectively made up from recycling. So I'll just stop sharing that now. What that means is that in order to get that much higher level of recycling out, which is needed to balance the numbers, the silver price probably has to go higher going forwards from here. And perhaps those who I've taken off now, but in terms of what's being consumed in silver, the biggest increases are coming from the electronics industry, automotive industry, and basically electronics are consuming 20% more, but photovoltaics are consuming 64% more silver in the current year than last year, according to the forecasts. So we've got a very strong bull case for silver at the moment, based on the supply and demand situation. And what I'd like to now turn to is how that relates to the silver price and the silver miners. Now, we've seen that the silver price has been climbing. Can I bring this up on my screen?
Yeah.
Perhaps I'll
Could I
bring
just
up.
add something about the Silver Institute as well? Is that it isn't balanced, like you said. There's a 200 million ounce deficit in 2024. And I wonder if they added all the silver that India and the Chinese stackers are buying as well, because India's been buying. They bought like a lot of silver. I think it was in February or March this year. They outpaced all their purchases probably for 1 year. So yeah, and there is also talk that the Silver Institute, yeah, they're credible, but they're aligned, with the big banks a little bit. So yeah, their research is interesting and their forecasts are interesting, but I would say that that deficit is a lot larger. I think they're trying to keep the market from exploding higher.
Well, I think the shorts could well be active in the market, but obviously sooner or later, if you're a short, you've got to deliver if someone at the other end is demanding physical delivery. And with the industrial demand going up, and probably stackers like you and I buying silver, I think people are going to be demanding delivery. Certainly, if you need the silver for your electronics industry, you can't not have it. You can't sort of trade it in the futures and say, well, I've got it, but I haven't, because you've got to use it at the end of the day. What I'd like to show, Mario, is the silver price in relation to the silver miners. If I could just share my screen here again. I hope that you see that okay.
Yeah, it's come up.
Okay, so on the right-hand side, you've got the silver price. This is as a percentage, not in price terms. It's as a percentage starting 4 years ago, both starting at 0% 4 years ago. And the silver price over 4 years is up 56% over 4 years. which is normal because of the widening gap between the mine production and the amount of silver being used. So it's normal that silver price has gone up by 54%. At the bottom in green, you see the price of the ETF, which holds one of the ETFs, the biggest ETF, which holds the silver mining companies. An ETF is an exchange-traded fund which holds all the shares in the index, and the index is an index of silver mining companies. And the ETF is down 14% over the 4 years, at the same time as the silver price is up 56%. So what's going on here? I think people have kind of lost interest in mining companies because they haven't been doing much. They've been selling their mining companies to buy more exciting things. But really, the gap between the price of mining companies and the silver price has widened to such an extent that those who feel that they can't bear the thought of buying silver 56%, 54% higher than they could have paid 4 years ago, could, if they want to get into an exposure to silver, go for the ETFs, the mining ETFs, where they're going to be buying it at below the price of 4 years. And of course, the mining companies, there's a very leveraged effect on their profits when the silver price rises. Because let's say a company's got a cost of production of $20 and the price is, let's say, $22. Well, they're making just $2 of profit. But if the price is now $30, well, they're making $10 profit. So the price of silver might have only gone up by 10%, by 50%, but the profits have gone up fivefold. So the mining companies probably in the current year are all going to be reporting much higher profits this year, next year, the year after, much higher profits than they've been reporting in recent years. And I've noticed that a number of them have come out with their first quarter report earnings so far, and usually that's resulted in a little bit of a leap in the share price when it happens. Of course, we're only talking about Q1 2024, but if those numbers are repeated in Q2, which I think they will be because silver is at the highest price for some years now, and if it follows through to the full year, we'll have very good results for the silver mining companies. And I think that could create a bit of a rush and a catch-up in the silver miners. So, Mary, would you like just to talk about the various ETFs which are out there?
Sure. And I see that this one is the SIL. You want to start with this one?
Yeah, so that's the biggest one. It's the SIL. Its proper name is the Global X Silver Miners.
Yeah.
I'm just going to stop sharing now.
Yeah.
I can just
Okay.
find my mouse. Oops. Yeah, found my mouse. Sorry. There we go.
I've done it for you.
Okay, right. That's perfect. So the SIL, which is the Global X Silver Miners ETF, has about $1 billion. So that's not a lot, but it is a lot for compared with the other ETFs. $1 billion of silver mining companies. The biggest companies in the index, in this index are companies like Wheaton Precious Metals, Pan American Silver, Buenaventura, Triple Flag Precious Metals, Korea Zinc Co. Don't know why zinc company's in there, but it is. First Majestic Silver, Hecla Mining, Kerr Mining, Industrias Penol, and Fortuna Silver Mines. So that's the biggest. But the another silver mining ETF that you can home in on is the iShares which is from BlackRock. The difference between the biggest one and the BlackRock one, the biggest one, that's the Global X, has got a total expense ratio of 65 basis points. That's 0.65%, which means that's eating into your profit less than 1% a year. Not very much, but it is eating into your profit. The iShares one is a much smaller fund ETF, but it's got a much lower expense ratio of 0.39%. So the iShares one is called iShares MSCI Global Silver and Metals Miners ETF. Symbol is SLVP, Sierra Lima Victory Papa, SLVP. And that's market cap, or the assets it holds, is 173 million. Now, just a word of caution for those who will say, I'll buy that one because the fees are lower. The downside to that is many banks don't recommend ETFs if they've got less than $500 million worth of assets, and some banks won't even lend money against the security of those shares. Usually it'd be okay, but you have to be aware that you're not buying quite the same thing if you're buying a small ETF over a large ETF, but at least you're getting lower fees. And this one has the same sort of companies in it: Pan American Silver Corp, Industrious, Pendoles, Hecla Mining, Newmont, First Majestic Silver, and Agnico Eagle, Fortuna, Silver Mines, Silvercrest, Mag Silver, Wheaton Precious Metals, and so on. Not all the same, but pretty similar. And the last one I think you could look at is a smaller fund which invests in the small cap ETFs. I don't have the size of the fund, but I imagine it's a smaller one than the iShares one, and it's called the Amplify ETFs. And the symbol is SILJ for juniors, or the Amplify Junior Silver Miners ETF. And yes, I see that's basically investing in small companies like Buenaventura, Harmony Gold, Pan American Silver, Hecla Mining, Kerr Mining, Wheaton Precious Metals, First Majestic Silver, and so on. So there's a little bit of overlap with the bigger ones. But the reason for considering a small cap fund as opposed to a large cap fund is the small caps usually have a much higher cost per ounce of silver, which means when the silver price rises, their profits rise much faster, and therefore the rise in share price should be much faster. But of course, that works in the opposite direction if the silver price goes down. So depending on your view of silver, if you think it's going to rise fast, you might want to buy the small caps, the juniors. And if you think it's going to rise more slowly, perhaps you want to buy the majors. But that's another way of getting into the silver market and having exposure without necessarily buying a silver price, which has already risen. I don't think the silver price is over, but at least some people might take the view that you never buy anything when it's up because you can always have bought it when it's down. What do you think, Mario?
I have a couple of comments before I tell you what I think. First, we're not telling you guys to go and do anything. We're just giving, Clive is giving his opinion and I'm giving my opinion. So this is not investment advice. Second thing that I've done before, if you're not inclined to buy ETFs, is to go into the ETF page and go to the prospectus and see which companies they own and try to copy them. You can do it yourself. So yeah, if you don't want to invest with BlackRock because you don't like Larry Fink, but it is easier to go through the ETF, but you can do it yourself. Just pick maybe two of the top 5 holdings, two of the middle 5 holdings, and two of the bottom 5 holdings. That's what I used to do. But I agree with you, Clive. Especially if people have quite a bit of spare savings out there. Yes, I think it's always good to have physical, and you should get physical. But if you have a lot of dollars or pounds and it becomes cumbersome, a way to play the move higher in silver is to do the miners, and it gives you a leverage. But as Clive said as well, it's very if it turns, it can get and it's very volatile, so you need to be aware of that. As for the price of silver, yeah, we're approaching 30. I mean, this morning I think we got to 29.80. I'm not sure where we're now, but I really think that when we break 30, silver is going to take off. They might try to keep it down a bit, but as you said, Clive, all the fundamentals are for silver higher, especially when you look at the Silver Institute research. And I would say that's pretty conservative. So I would say the deficit is a lot bigger. And if you think about the gold silver ratio as well, 80 is a key level. So if silver blows through 30 and gold is around 2,400, that means you're going to go below 80 because, 3 times 8 is 24. So 30. So I think we are, very close to a major move in silver.
Perhaps I should just also change the subject slightly, Mario, talk about interest rates. There were two developments which I think have gone under the radar screen a little bit with the conference in the Netherlands in Amsterdam with Jerome Powell. I personally think he's moving away from the 2% inflation target. Now, that's my opinion. He didn't say that, but I'll just read you some words which give me that sense that maybe that 2% inflation target might be going to shift at some point in the next 6 months to a year. He said, I expect inflation to move down to the lower levels we have been seeing over the last year. So that was a level above 2%. My confidence is not as high as it was having seen the readings. So he's losing confidence that they'll get that 2% target, although he did later in the interview say they will get there. And he also said, he was asked whether inflation is going to be persistent going forwards. And he said, restrictive monetary policy lowers inflation, it cools the economy. I don't think we know that yet. I think we need more than a quarter's worth of data. I think there's some more there. I don't want to give up on it yet at this point. Yet. So I thought that was the key word. He's not giving up on the 2% inflation target yet. So to my reading, I think he's realized they're possibly not going to get to the 2% target, even though he said they will in a year or two. And at some point, he may give up on it, and we may find we have a new target of inflation of 3%. He was also pretty adamant in that interview that, well, wasn't adamant, but it came across to me that they're not going to reduce interest rates anytime soon. But that's not terribly new, but it was basically repeated. But the other thing he did say is that at this point, there's no suggestion that the next move in interest rates will be upwards. So kind of there's a shift again from what he was saying, which was the next move in interest rates will be downwards, to it won't be upwards. I think it's a very, very subtle shift in wording, which implies that the Fed might not be going to cut interest rates anytime soon. And that's in complete contradiction to what was said by Klaus Knot, who's on the ECB. He's part of the member board of the ECB, which decides the interest rates. And his words, in contrast, were, and I'll read what he said, and this is implying that they will cut in June. And he said it twice, by the way, in different ways. He said, I believe that inflation is probably less persistent in Europe than in the USA. That leads me to conclude we can remove some of the monetary restriction. I'm confident that if the June data confirms the picture that we've seen, I'm confident that if the June picture confirms it, then we can make our first move in June. In other words, it seems almost certain that the ECB is going to cut rates in June, and it's almost certain from hearing Mr. Powell that he won't.
Yeah, but you think Powell's leaning more towards going to a 3% target?
I think we're quite some way off that, but I think the subtle changing wording means that we're down the line, we're going to across, not only in the USA, but across the world, have a change in the target of 2 moving upwards to 3. This is not going to happen overnight. It's going to be a very gradual and slow, subtle shift of the wording. And at some point, when we're above 3% inflation, they'll shift that target. That's my opinion.
Yeah, and I think to most people out there, it doesn't mean anything. And most people say it was just 1%, but actually it makes a huge difference over 10, 15, 20 years. And I wanted to show you, Clive, you're talking about interest rates. I saw this article yesterday, and it says here three banking giants slash mortgage rate to slash mortgage rates. So mortgages are falling amid hopes central interest rates could be cut as early as the start of the summer. So Barclays has announced it's lowering its fixed rate mortgage deals by 0.45% Friday. HSBC and TSB have also announced rate reductions. And why is this significant? Well, I made a video maybe a month ago or so, uh, and the title was, I think, something like, "Are you expecting UK house prices to crash? Think again." You know, because I think that's the whole problem for Powell and the ECB and the Bank of England, that if they don't start cutting again, the whole house of cards could implode because, you know, people are having a tough time refinancing. And I think the Bank of England must have given these banks a little nudge. And I think rate cuts are coming, not just in the EU, but in the UK. And in the US, they might not come. But do you remember, Clive? Um, I, I think it was the last FOMC, Jay Powell said they're going to slow down the QT to a rate of, you know, it's going to equate to more than about $420 billion that they're going to not sell a year. So, yeah, I agree with you. And I think commodities, you know, like copper, gold, the monetary commodities, and silver, they are already forecasting this. Do you agree?
Yeah, so I think, yeah, well, absolutely. I think the next thing which happens in the USA is a funding problem, because the government is having to raise and borrow more and more money to finance their expanding budget deficit. They're spending more than they collect in taxes. But not only that, the interest rate that they're paying on their national debt is rising very, very rapidly, because we mustn't forget the interest rates have gone from near to 0% to now at the short end 5.4% in America. So the Treasury, that's the US government, is paying far more on its maturing debt when it has to refinance it, and far more on the new debt that it has to borrow than it was paying over the last decade. And that's increasing the interest cost to the taxpayer, which of course means that the amount it's got to borrow is starting to rise faster and faster just to pay the interest alone. And we could get to a point where they have difficulty raising money from the public at the current interest rates of, because don't forget the bonds are about 4.4% for the 10-year, whereas the short-term rate is 5.4. But they might start to run into difficulty, especially if they're not lowering the short-term interest rates. They might run into difficulty raising money for 10 years at 4.4%, the current interest rate, and they would therefore have to start to offer those bonds at a higher yield, borrow at higher rates. And there comes a point where that becomes so unsustainable that the Federal Reserve will be invited politely, because they're not following orders apparently, to step in and buy those bonds. But how does the Federal Reserve buy the bonds? Well, the only way to buy government bonds is to print the money. That's your liability. So you can buy the asset, which is the government bonds. So that would be turning from quantitative tightening, which is the phase we're in at the moment, which is where the Federal Reserve is trying to shrink its balance sheet, into quantitative easing, which is what we had a few years ago, where the Federal Reserve starts to expand its balance sheet because it will have more liabilities, i.e. the cash it's printed, and more assets, the government bonds it's bought. But it might have to do that, because if it doesn't bail out the government, we could go into a debt spiral. But of course, if the Federal Reserve is printing money, that's basically short-term money in the system, and that money has to find its way into something. And of course, it will push up all kinds of things which are in short supply, like labor, medical costs, and of course, asset prices.
Yeah, and I don't think China's going to come to the rescue and buy more treasuries. That's not going to happen. And as we wrap up here, Clive, I've had a look here. There's no real data out later on today. We are talking. It's 9:16 London time. I see, though, Clive, that at 5 p.m. London time today, we're going to get the first quarter GDP for Russia. And it's expected to rise at 5.3% from 4.9%. So it looks like they're their economy is doing well.
Well, it creates lots of jobs if you're building tanks.
Yeah, and I think the West is trying to follow that path, unfortunately. But yeah, so any final thoughts, Clive?
Well, as you said a bit earlier, nothing that we said about silver or anything else is supposed to be investment advice. And if you are investing into anything, make sure you only put a little bit of something into everything. It's it's a mug's game to put everything into one thing, i.e., all the eggs in one basket, because you only need it to go wrong and you're out of the game. If you diversify, yeah, you don't make as much, but at least you are always in the game and you never fall out of the game.
Great. That's very good advice. And before we wrap up, if you want to connect with Clive, yeah, go to LinkedIn if you're on LinkedIn, and it's Clive Thompson, and he will, he'll accept your invitation. He writes a lot of stuff there regularly. Clive, have a great weekend.
Thank you, Mario, and thanks to all your listeners who did write to me, and I've answered a lot of questions, several per week, so more than happy to do that for your listeners.
Thank you. Take care.
Bye-bye now.